I'm Joe Galvin, Chief Research Officer for Vistage, here to share the insights and analysis from the Q2 2025 Vistage CEO Confidence Index. Our latest quarterly survey captured sentiment from over 1,500 CEOs over the first 2 weeks of June. The CEO Confidence Index dropped just 1.3 points from last quarter to reach 77.2. We saw a post-election spike in Q4, but now we see the index has returned to the post-COVID trend line, with Q2 being only down 3.2 points off the last 12 quarters average of 80.4. That's going back to Q3 of 2022. Economic expectations continue to weigh the index down, with only 31% of CEOs seeing improvement in the year ahead, and 33% expecting the U.S. economy to worsen. This is in turn pulling down CEOs' expectations for revenue and profits, both under the 3-year average. Expansion plans continue to be conservative, with CEOs holding back investments, hiring, and again, both under the 3-year average. Uncertainty continues to rule the day. So to provide some clarity and context, we welcome back our friend, Lauren Seidel-Baker, Senior Economist at ITR Economics. Lauren is a co-host of ITR by the Numbers podcast and has been interviewed on NPR Marketplace and Bloomberg. Many of our members have had and will have the opportunity to see her at Vistage Executive Summits, most recently in Pittsburgh in June. Welcome, Lauren, and thank you for joining us today.
Thank you so much, Joe. Great to be back.
Great. Well, Lauren, the confidence index declined marginally from last quarter. CEOs remain challenged by tariffs, inflation, interest rates, and people issues, the usual suspects. ITR, however, maintains a positive outlook for 2025 and beyond. Can you help us connect the trends in the Vistage CEO Confidence Index with ITR's economic analysis?
Yes. So here's the unique part of economics, but where we get into the fact that there are no binary outcomes, right? We can talk about economic growth and economic contraction, but more often than not, we're in just this middle road. Growth is not bouncing back, surging forward, but we also don't see the bottom falling out from our economy. So that's the signal I am getting from a lot of leading indicators like the confidence index today. If we look at the confidence index on a rate of change basis, we're seeing positivity but slowing growth. So it's that mixed message. ITR does still expect growth in 2025, but more moderate growth. It's going to be a little bit more sluggish at first and then start to gather momentum the second half of this year and into 2026. So when I say there are good things ahead, a lot of this is just about level setting expectations. This is not surging activity that we have the wind in our sails and that all systems are go. It's that all systems are doing okay. Nothing is really falling off. But as you mentioned, there's so much uncertainty out there that's causing some hesitation on the part of business. And at the end of the day, hesitation, delaying those outcomes, it's not canceling the positive movement, but just moving forward at a more subdued pace.
The headlines seem to move all over the place, from everything is great to everything is terrible and somewhere in between. What is it that CEOs should be looking for over the next quarter as signs of growth and, more importantly, maybe some stability?
Really, it comes down to knowing your markets, knowing your own leading indicators. It's very easy, especially today with geopolitical concerns, tariffs, trade wars, outright wars. It's easy to get caught up in the excitement of those events. So don't look at the immediate headline leveled. I don't even look at like daily price indicators at this point. I'm trying to zoom out, take at least a quarterly average, if not looking at the even longer term, a 12-month moving average, 12-month moving total. We use our rate of change analysis because it does look through some of that daily volatility or even weekly or even monthly volatility. So at this point, we're still tracking those broad indicators that are showing signs of stability. So something like overall B2B spending. If you're in that CapEx market, you can start to see where the gears are turning, what previous cycles with, say, interest rates are just now starting to flow through in your real economic outcomes. But these indicators won't be the same for every business. It just depends on what matters most to you.
You know, CEOs are pressured to maintain margins. As we dig into the data, we see nearly a quarter expect profitability to worsen in the next 12 months. Data shows that 49% plan to increase prices in the next 3 months to keep pace with rising costs. What can you tell us about the outlook for inflation?
I'm so glad that CEOs are paying attention to margins because that is the number one risk to business and to their bottom line that I see coming forward. ITR is starting to warn about this period of potential profitless prosperity. That is, we get so focused on the top line, on the revenue and growing that number that we sometimes miss the mark over the impacts of inflation, our rising cost structure. We have to decouple indicators that are based on real dollar value and real volume or units-based value. So the risk, I think, is getting excited about revenue growth, and we always should be excited about revenue growth, but knowing what cost it comes at. Margins are the key thing to watch going forward. Now, where we stand today in mid-2025, we've seen pricing pressures on, say, the labor side. That's been with us for some time. We've gotten used to it. The goods side of inflation has been a bit more subdued. We're starting to see signs that's picking up steam right now with regards to both tariffs and these other risks, but also with regard to just general demand pickup that's going to cause some pull on prices. If we do get a broader war and that has real impacts for energy costs, well, there's another factor that really will be affecting businesses' profitability at the end of the day. So be laser focused on your margins. If you have efficiency gains that can be made, this is probably a good time to do them. But whatever investments taking place, whatever you can do either with your labor force, with your existing capacity, at the end of the day, it really comes down to that margin equation.
Lauren, what are some of the biggest pressures that you see on this margin equation?
I think the biggest margin pressure and the one that I'm afraid CEOs are losing sight of is the labor side of things. Now, we know wage pressures have been with us. That's been a concern really in the wake of the pandemic. Once that recovery started, labor was the first thing to get pinched. I'm concerned that a lot of CEOs feel like they're out of the woods because things have gotten better, because there has been some amount of directional loosening in the labor market to say, this is better, therefore it's good. It's better, yes, compared to the incredibly tight starting point we saw, but demographics are still against us. There still is not wildly plentiful labor availability, especially in those key skilled roles. So at the end of the day, we at ITR are suggesting that the average business stress test a 28% increase in total labor costs between now and 2029. That is significant. And just because you had a higher percentage change in your labor costs last year compared to this year doesn't mean you can straight line project that cooling wage pressure. This is the number one thing and the number one reason that I think efficiency gains still do need to take place. We need to be more efficient with the labor we do have. But at the end of the day, we also need to budget for those higher labor costs because you don't want to lose your trained and skilled employees for a slightly better salary across the street.
You know, Lauren, you brought up investments. We see sluggish rates of investment is 28%. Now, that's an incredible number in our history. 28% of CEOs report reduction in CapEx expenditures since the start of the year. So they're reacting to this. The Fed most recently held interest rates steady, but still suggests maybe 2 cuts in the second half. What's your outlook on interest rates and how should CEOs react to that?
I think we are about as low as interest rates will go this cycle. So if you are waiting to make that investment until you say we get maybe another 25, maybe even another 50 basis points on that Fed funds rate, please don't wait too long. Please don't miss that mark. If this investment needs to take place for, again, your own efficiency, your own capacity, if you'll see that demand on the other end of this cycle, I really wouldn't be waiting too long to get the gears turning. Now, I mentioned a lot of inflationary pressures, and so the Federal Reserve, they're also aware of those same inflationary pressures. We've started to hear some Fed speak talking about cracks forming in the labor market, but most of our indicators show general balance and even still some tightness. I think CEOs would agree with these, especially the ones who are still struggling to fill those vacant positions. The labor market is not materially looser than it normally is over history. Maybe it's looser than that ultra tight point that we saw in 2021 and 2 and 3, but it still isn't a labor market completely out of balance to the degree that the Fed really needs to be cutting rates to prop it up to support the labor market. So with inflation and already a concern, more inflation coming down the line at us, the Econ 101 textbook says, that means the Fed should be talking about raising rates, not cutting them. And that's why I'm hesitant to really wait for more cuts. We're seeing some mixed messaging from the Feds. If you look at the new SEP and the dot plot on Fed expectations, starting to see two camps, but the general direction is still that move toward maybe this rate environment for a little bit longer. We're in that so-called data-dependent environment again, waiting to see what the impact of things like tariffs, of the war, of these other inflationary pressures will be. And ITR's forecast is for building inflation. So at the end of the day, if inflation is higher, that really will limit the Fed's ability to cut rates further.
Well, Lauren, we have to talk about tariffs. You brought that up. 33% of our CEOs report direct negative impact from tariffs. Another 36% report indirect impacts. The unpredictability of the tariffs, the trade deals that are on or not on, that rages on. What are your thoughts on tariffs, and is there a different way to play this than what we've been doing?
I have to give it to Anne, who at the most recent Vistage Summit I attended, she used the term Mr. Miyagi tariffs, and I'm stealing this. She said it's tariffs on, tariffs off. And I love that image because that's what it feels like we are existing in. Ever since the Trump administration, came in January, it's been tariffs, and then we pause the tariffs, and then a court case maybe blocks the tariffs, and another court blocks that court decision. It's so much on again, off again. That is really hard for businesses to use for planning. The good news is, I think the US, especially business community, has gotten a lot better at looking through volatility. Maybe it's just volatility fatigue at this point. We are so sick of things coming at us left, right, and center, but we've gotten used to looking through. And I think this core group of Vistage CEOs really knows what metrics matter. So yes, tariffs are inflationary. Yes, you need to shore up your supply chains. We know that these factors will be true, whether tariffs are higher, lower, here, gone, whatever they might be. At the end of the day, we're starting to see more of that acceptance that there might be some additional costs from tariffs, but I just can't wait to know finally. And we're getting closer to that July date when we should, I say should, at least with fingers crossed, have more visibility on what tariffs will be in place. But this ongoing negotiation, it's giving us something to follow in the news flow. Businesses, though, they need to make their broader decisions with this as just one input, not as the be-all, end-all of their strategy.
Lauren, finally, uncertainty and unpredictability continue to plague CEOs of small and mid-sized businesses. They really can't get a handle on what's going to happen next. Your outlook suggests a more positive outlook for growth. We reviewed that. What could change that?
A lot of things could change this, but very few of them come from the world of economics. So what I'm most focused on right now really falls outside my expertise. It's things like geopolitical tensions, war propping back up. If conflict does emerge and let's say expand in scope, if we get additional players into this conflict in the Middle East, currently the scope seems at least somewhat contained. But the Iranian parliament, for example, has threatened to shut down the Strait of Hormuz. That could have impact on oil prices, as about a fifth of the world's oil transits through that point. These are the factors that we're watching, but these are the known unknowns. What really worries me the most is the unknown unknowns. Does some other major power come into play? Does something else altogether happen? It seems like we can't catch a break in terms of the news flow. Now, that's not to say that businesses need to be in wait and see mode, waiting for that next, I was going to say bomb to drop. That's probably not the right circumstance, but for the next news headline to hit, really, I see the fundamentals as winning out. Even oil prices with the conflict in the Middle East, they have not moved as significantly as they did, for example, back when Russia invaded Ukraine. So we're seeing a more muted market reaction, and more than anything else, we will see the fundamentals win out at the end of the day. If there's a war, maybe that changes some of these things, but for where we are right now, I would say businesses just need to follow their fundamentals. They need to follow their ultimate demand drivers. As tight as things feel, the U.S. consumer is doing quite well. That will support overall GDP growth. And at the end of the day, demand is coming back. So if you're waiting on the sidelines, you might not be ready.
Lauren, thank you so much for your time. Once again, we look forward to speaking with you every quarter. Your guidance and analysis will help our leaders of small and mid-sized businesses understand what to expect as they head into the second half of the year. I look forward to our conversation in September as we begin to look ahead to next year and what that might mean and what unexpected economic experiences we might see. So, Lauren, thank you again. I'm Joe Galvin, Chief Research Officer, and thank you for tuning in.